from Western time, from Pacific time, Mountain time, and a variety of other time zones. So whatever the time it is in your time zone, it's 12 noon here. So let's go ahead and get started. On behalf of Sikich, I'd like to welcome you to our first quarterly 2021 Governmental Accounting webinar, your source of knowledge and free Yellow Book continuing professional education credit. We have about 200 participants from all across the country today, representing governments of all types, from general purpose governments such as counties and cities to special purpose governments such as school districts, community colleges, technical colleges, park districts, and library districts. And we have folks representing all sizes of government, from some of the largest cities and counties in the region to some of the smallest jurisdictions within this region. Now, this breadth of governments participating today demonstrates some of the challenges that the Governmental Accounting Standards Board has, especially in trying to establish accounting and financial reporting standards for such a diverse group of governments with very, very diverse groups of user needs and information needs. So this also makes our presentation a little challenging today, but we're certainly up for the challenge, and we'll do our best to make sure that we hit every aspect of large governments and small governments as we go through the material. We do have a housekeeping item or two before we get started that I need to go through. First, we're going to have all the attendees muted, because with close to 200 attendees, if we don't keep you muted, we might end up with some background noise that might distract some of the other attendees. So we will stay unmuted. If you do need to ask a question or address anyone, you see the little chat box down here? You can go ahead and type in the chat box and send a question or request to the organizers and panelists, or to anyone in the group. You can send it out to everyone if you'd like to. So we encourage you to go ahead and submit those questions or any comments that you have via that overall chat box, and through that. We will do our best to address any questions that you might have throughout the presentation. If for some reason we don't get to these throughout the presentation, we will do our best then to follow up via email to the participants who asked those particular questions. So if you're interested in a copy of the slides, also you can see on the key there, right below handouts, we pop that open and you can download the PDF of the handouts for today. We do have about 75, 76 slides, somewhere around there, to go through today. And I always find that when I'm attending a webinar, I like to download a copy of those, and sometimes I'll jot notes on right on my copy of the slides. I find it helps me retain stuff a little bit better that way. So for those of you that are interested in continuing professional education credit, like I am, we will launch a short survey at the end of the webinar. And even for those of you not interested in CPE, we'd still like to hear your comments on the short survey. But if you do need CPE, when that survey pops up, please make sure that during the presentation, we will give out 5 keywords. Please write down those 5 keywords, and then you'll enter them in the box on that survey at the end. And then once you complete that survey with those 5 keywords entered in, or at least 4 out of the 5 keywords, I believe, to maintain compliance with NASBA requirements, because we are a NASBA certified CPE provider, then you will receive your continuing professional education credit for that. And correct me if I'm wrong, I believe we're going till 1:15 today. So in CPE hours, that's 1.5 continuing professional education credits you will receive for today, if you attend the entire 1 hour and 15-minute presentation. We do have about a 2-week turnaround time then for emailing the CPE certificates to you. So be patient with us as we process the information. But if you do not get the CPE certificate from us within a 2-week time frame, please reach out to us, and we'll make sure that you do get that follow-up emails, or that follow-up certificate emailed to you. So I have a special shout out I'd like to make before I start to some of the folks that we have attending from northern Wisconsin and northeastern Minnesota. I think we have some folks from Rusk County and Eau Claire County, and some other folks up in northern Wisconsin. I want to give you a shout out. I was visiting your area over the weekend when I went to visit my son in Duluth, and to take advantage of some of the end of the season ice fishing up in Bayfield, Wisconsin, and up in Hayward, Wisconsin. What a beautiful, warm weather y'all had up there on Saturday. That was so nice to be out on the ice on that, doing some fishing and spending some quality time with my son. And boy, oh boy, did that change on us on Sunday, didn't it? Overnight Saturday and Sunday morning turned into a little bit of a snow event, bordering on whiteout conditions. I had a whole lot of fun driving basically from, leaving Duluth Sunday morning, and I think the snow kept up all the way down till just outside of Eau Claire, I'd say. Once I got to Eau Claire, the temperature hit 35 degrees and the snow was pretty much rain and something else. But boy, what a whole lot of fun for that. Thank you for that end of the year snowstorm for me to drive through. Really appreciate it. So, okay, it is lunchtime, so go ahead and grab some sushi for lunch, or when we go ice fishing, we call that bait, but you all can call it lunch and call it sushi. Sit back and let's have some fun talking about GASB pronouncements that might impact y'all in the not too distant future. To achieve that today, we have 2 presenters that are going to be participating. First is myself. For those of you who don't know me, since I don't carry the American Express card, my name is Fred Lance. I'm Director of Government Services here at Sikich, and I've been with Sikich for about 28, 29 years now. Before that, I was with the Government Finance Officers of the United States and Canada. While I was at GFOA, I managed the Certificate of Achievement program and developed and served as instructor for many of the GFOA's accounting seminars and accounting programs, and also did help out in writing a number of their publications as well. In addition, I've spoken at many of your state and local conferences previously. I really miss seeing you all in person. Webinars are just not the same. All I see in a webinar on my screen is either my picture talking to myself or Anthony's picture. And Anthony, you look great, but tired of looking at just you. So hopefully we'll be able to be in the same room at a conference at some point in time in the near future, and we can have some better interactions. So I'll turn it over to Anthony now so he can introduce himself.
Well, thank you, Fred, and good day, everyone. Good morning, good afternoon, wherever you may find yourself. My name is Anthony Cervini. I am the partner in charge of government services at Sikich. Like Fred, I'm looking forward to the days. Hopefully sooner we can get back in front of folks and do these things in person. I spent my entire career at Sikich working with our state and local government team. Also active speaker for the IGFOA, WGFOA, active with the Illinois CPA Society. Excited to be here with you all today and go through, certainly the Government Accounting Standards Board has been busy, so we've got a lot of great material for you. With that, I'll turn it over to Fred just to share a little bit more about who we are as Sikich.
Thank you, Anthony. So a little bit about background for those of you that aren't that familiar with Sikich. We are a multidisciplinary professional services firm. In addition to auditing and accounting, we provide technology and advisory services, and we have clients all throughout the United States and all across the world. One of the things that we hear from our clients most often is that we have an excellent reputation for providing professional services and ensuring that they're provided on a very timely and accurate, and most importantly, in the government industry, a cost-effective basis. So we have more than 1,000 talented people all across the country, including over 100 partners, all of whom devote their careers to a focused area. Believe it or not, we have, I believe, 10 or 11 partners now, and more than that with our recent addition of some folks down in the St. Louis area, and welcome to all of you. So right now we probably have about 15 or 16 partners devoted to the state and local government industry, and probably about 100 to 120 staff devoted to that industry as well. So you don't have to worry about us going away or something happening if to your engagement, if a particular Sikich member is no longer there to participate in your engagement. We have a wealth of folks that can fill in for that. We've been ranked as the country's 28th largest accounting firm and the 7th largest value-added technology provider, both nationally and by Accounting Today. So most of you know us from our accounting and auditing services, but we do provide a wealth of additional services to a variety of industries, including the state and local government industry. So in addition to our traditional audit, accounting, and tax, we have a full technology division. It does a lot with ERP systems and CRM or customer relation management software. We do a lot of IT consulting, including cloud and hosting services. What we're really known also for in our Milwaukee office is IT security services. We have a great security and compliance and cybersecurity group out of Milwaukee. So, and then last but certainly not least, our advisory services. And I think most of you could be interested in a variety of those advisory services, with the exception of perhaps investment banking. I don't think we've had a takeover of a state or local government probably since back in the Civil War days. So I'm not sure investment banking or who knows, maybe somebody wants to, who could we pick on? Oh, Aurora and Naperville. Maybe Aurora wants to acquire Naperville or vice versa. We could get our investment banking division involved in that and see what the purchase price for the city of Naperville might be from its residents. So just kidding before everybody says something on the evaluation. So, okay, that's enough about us, enough about the presenters. Let's go ahead and jump right into our material today. So the first topic we're going to talk about is GASB statement number 95, postponement of the effective dates of certain authoritative guidance. Knowing that we're under a lot of stress in the government industry today due to the pandemic, GASB has provided some relief to us with the issuance of GASB statement number 95. What they've done is basically told us that we can defer the effective date by up to 1 year for some pronouncements, or by up to 18 months for certain other pronouncements into the future, and not have to worry about implementing those right now, while most of us are working remotely and just dealing with the challenges of maintaining our operations while we're working remotely. key with GASB 95 is it automatically extends those effective dates. You can still choose to early implement those based on the original effective date. However, you're now given the option of deferring those to that future effective date. So what did GASB defer under statement number 95? What you see on your screen now is a list of those pronouncements that GASB postponed for 1 year in their entirety. So for example, GASB 83 was deferred for an entire year from an implementation standpoint. I disagree kind of with GASB 83, but we'll talk about that in just a moment though. The key with these though is you can choose to defer them based up to 1 year. However, you must defer the entire pronouncement and the implementation of the entire pronouncement. You can't go to GASB statement 84 and say, you know what, I like this component of statement 84, so I'm going to implement this now, but the rest of 84, I don't have to implement for another year and a half, so I'm going to put that off. We can't do that. It's really an all or none option. So you either defer the entire pronouncement or you implement the entire pronouncement, one of the two. And I must say that a lot of governments are choosing to defer some, especially one that we'll talk about in just a moment. So again, these are deferred in their entirety for 1 year. What you see on the slide now on your screen are those where only certain provisions of the pronouncement have been deferred for 1 year. Specifically, GASB statement number 92, which is an omnibus statement, deferred paragraphs 6 through 10 and paragraph 12, which we'll cover in a little bit. On GASB statement number 93, paragraphs 13 and 14 were deferred 1 year. That kind of ties in with some LEASE criteria. And then implementation guide number 27-3 had certain questions that were deferred for 1 year also due to the implementation now of GASB statement number 84 and the deferral of that. These two pronouncements are postponed for up to 18 months. And actually almost 2 years in some instances. And that's the wonderful GASB statement number 87 that I know you all are looking forward to implementing in what was the not too distant future, but now will be off in the future a little bit for us. And the sister pronouncement to that is implementation guide number 2019-3 on leases. The deferral of that is also for 18 months now. And again, we have to defer it all, not a piecemeal deferral. You're probably thinking right now, oh, gee, Fred, I have a headache just from hearing about this. Can you somehow summarize this for us, maybe by fiscal year end? Well, fortunately, we've done that for you in your materials. So if you have a June 30th fiscal year end, these are your new effective dates for these pronouncements. So fiscal year June 30th, 2020, if you did not implement GASB 83 or 88 last year, then you do have to implement those for as of June 30th, 2020, or I'm sorry, 2 years ago. That's one I disagreed with because those all should have been implemented before that fiscal year end. But I won't go there too much. I'll stay off my platform on that. June 30th, 2021, which is coming up this year, you all are going to have to implement GASB 84 and fiduciary activities unless you've already implemented that, which a lot of our clients did implement statement 84 on a timely basis. Likewise, you can push off statement 90 and 93 off till 2021, as well as the two implementation guides, 2019-1 and 2019-2, specifically on fiduciary activities. If you do push these, look at what happens with June 30th, 2022 fiscal year ends. Boy, you've got a lot to deal with for June 30th, 2022 with leases, GASB 89 on construction period interest, 92 on the rest of the omnibus pronouncement, statement 93, which really doesn't impact a whole lot of us. I think it impacts 3 people that are on the call today or on the webinar, so we'll go over that. And then statement number 97. June 30th, 2023, you can push off 91, statement 94, and statement 96. Those are the original effective dates for 94 and 96. Those were not covered by GASB 95 because they came out right after GASB statement number 95, as you can tell by the numbering issues here. So if you're a December 31st year end, you're probably interested in the next slide then. So for December 31st year ends now, you're going to be dealing with implementing GASB 84 if you did not do that for December 31st, 2019. And for those of you on the call, we do have a number of good examples, either the Village of Palatine, Illinois, the Village of Huntley, Illinois, both of their 12/31/18 and 12/31/19 CAFRs early implemented, as did, I believe, the City of Madison, Wisconsin implemented GASB 84 for the year ended December 31st, 2019. So we do have a wealth of good examples out there. Don't worry about reinventing the wheel. Somebody's invented it for you. Just pick those up and follow along as to how they've done that. I think it'll be a good roadmap for you. So likewise, statement 88 will be effective then, and statement number 90. So those of you with a 2020 year end for December 31st, you do have a lot to deal with right now. 2021 be an easy year. 2022 is when you're pushing leases off until now. So that does give us quite a bit of flexibility now in pushing off that lease pronouncement. 12/31/2023 then would be GASB 94 and GASB 96. Now you're probably saying, well, Fred, that's great for June 30th and April 30th, but what about us governments in Illinois with our funny April 30th year ends? Anthony convinced me that yes, I should go back and put in a slide for the April 30th year end. So here's the same information, but by April 30th year end. So now, what do you notice? All my slides end at 2023. Anybody know what happens in 2024 or 2025? That's when you're going to be implementing that new reporting model that the Governmental Accounting Standards Board is coming out with. Probably going to be effective for years ending June 30th, 2024 or June 30th, 2025, depending on the size of your particular jurisdiction. I don't know if a lot of you were around for implementing GASB statement number 34. I led the implementation of that for a lot of jurisdictions, and that was a whole lot of fun. I had so much fun implementing statement 34 and changing all of your reports that I'm making sure I retired before 2024, before this new reporting model takes effect. And for those of you that are in my same category, I'd encourage you to look at retirement before that takes effect as well. Unless you really enjoy implementing new standards, then stick around. You'll have a whole lot of fun implementing those new pronouncements. So that's what GASB Statement 95 has done for us. Again, defer the effective dates of many of these pronouncements. Now, in addition to that coronavirus relief, GASB gave us some additional, I wouldn't say coronavirus relief, but in this instance, coronavirus guidance, because GASB was getting a whole lot of technical questions submitted through their website regarding how to account for some of these transactions that we were all faced with and some of the funding that we were receiving from the federal government to address some of the COVID-19 issues that we have. So GASB issued this particular pronouncement then, GASB Technical Bulletin 2020-1, back in June of last year. And that really was just issued to deal with 6 particular questions as to how to treat certain transactions related to the CARES Act funding. So now, one thing to remember, GASB GASB Technical Bulletin is what we call Category B gap. So statement 95, that's Category A gap, Level 1 gap. This is Category B gap because it doesn't go through the full due process that a normal standard would go to. In addition, this pronouncement was effective immediately upon issuance, something we don't often see with a GASB pronouncement. And statement number 95 was also effective upon issuance. So what are the 6 questions in Technical Bulletin 2020-1? Let's go through those briefly. First, question number 1. Are the resources received from the Coronavirus Relief Fund subject to eligibility requirements or to purpose restrictions? That comes from GASB statement number 33 and tells us then when we should recognize revenue from these transactions, because the revenue recognition is very different if we have an eligibility requirement to meet or just a purpose restriction to meet. And the response from GASB was that the coronavirus relief funds are subject to eligibility requirements as defined by the U.S. Treasury. Now, these aren't really grants, and GASB statement number 33 applies to non-exchange transactions, but a lot of us just think grants in that instance. So even though these aren't grants, we're still going to apply GASB statement number 33 to it because it is a non-exchange transaction. So funds that you received should be reported as a liability if you receive them in advance, especially those of you larger governments that received all the dollars in advance directly from the federal government. You would report those as a liability, unearned revenue, until all the eligibility requirements are met, unless the only eligibility requirement is a timing requirement, then of course it's a deferred inflow. But if it's an actual eligibility requirement, meaning you have to incur a qualifying expenditure before you can recognize the revenue, then that's reported as a liability and unearned revenue until the point in time as you do meet all the eligibility requirements and then recognize that as revenue. If you're one of the governments that didn't receive the money directly from the federal government, but instead you're waiting for reimbursement from a large county or large city or the state that you reside in that instance, you'd recognize a receivable and revenue and accrue those when you've incurred the qualifying costs that you can be reimbursed for. And again, that would be subject from a revenue standpoint to your revenue recognition criteria in terms of how many days after year end you will recognize revenue based on a collection period for that. So I thought that was very, very good guidance in Technical Bulletin 2020-1 for us. And I know it answered a whole lot of our clients' questions about when to recognize revenue from this. And we did see a lot of competing thought processes on that. So I'm glad GASB gave us just one set of criteria to apply for that. So, okay, the second question, certain CARES Act programs provide resources to address the government's loss of revenue. Now, before you all get excited, this is a very, very limited instance. This is primarily for government and county-owned hospitals and certain college and university hospitals. Again, very, very limited applicability for this. They said, should this be considered an eligibility requirement for purposes of revenue recognition if it's for lost revenue? And GASB came back and said, yes, it would. Now, with your second or third coronavirus relief, if it does pass now, Congress, the $1.9 trillion that's working its way through Congress now, I understand that a portion of that does apply to loss of revenue. So they've already addressed that question for us in terms of when we should recognize the particular revenue from that. So, oh, that brings us time for our first keyword now. And we made this one very easy. So our first keyword for the day is GASB, GASB. So again, if you're looking for continuing professional education credit, please make sure you write down that keyword and then put it down in that box in the survey at the end. And we'll make sure that we give you 1.5 hours of continuing professional education credit. And again, it's that great yellow book CPE, my favorite. GASB going once, GASB going twice. Not really, just the keyword GASB. I know some of you are thinking, yes, go, 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 but just the keyword. Okay, question number 3 then from Technical Bulletin 2020-1. If amendments are enacted to the CARES Act after your government's fiscal year end, meaning your statement of net position date, but before you've issued your financial statements, should you consider those amendments as a basis for recognition in financial statements for the period reported? Boy, I'm glad GASB addressed this because we all know it was kind of a moving target with the CARES Act and what was going to be eligible for reimbursement under the CARES Act for a while there. So GASB said no, any amendment to the CARES Act that was enacted, meaning it came out of the Treasury Department after your fiscal year end, after the statement of position date, should be considered a non-recognizable subsequent event pursuant to paragraphs 8 through 12 of GASB Statement 56. Now, I'm going to get on the soapbox for 30 seconds here. I know GASB 56 pretty well, and I know paragraphs 8 through 12 very well. To me, this is a recognizable subsequent event. This is exactly what this was addressed for, but I understand the moving target criteria that we have, so I can understand why GASB came out with this particular response in their guidance. What you all need to be careful of with this, though, is you may have revenue recognition now different than expense recognition for single audit purposes. Remember, the single audit is not driven by revenue recognition. The single audit and what goes on your schedule of federal expenditures is driven by expense recognition. So even if you incurred a qualifying expense during the period, even for something that's allowed by the CARES Act after the end of the fiscal year, it should still go on your CFA. This only covers the accounting, not the single audit guidance. So what you may result in, or may have as a result of this, is inconsistencies in how you recognize revenue for this transaction versus when you recognize this as an expense on your schedule of federal awards that you submit as part of your single audit of federal expenditures. Do you understand? There's nothing wrong with that conflict or that difference, but you do have two different sets of competing standards there to apply to those same transactions. Question number 4. If a governmental entity received a forgivable loan, oh geez, I wish a lot of us could have received those, pursuant to the Paycheck Protection Program, and you determine that the loan will be forgiven in a subsequent period, do you still have to report that loan as a liability at your current fiscal year end? And GASB said, oh, this is an easy one. We'll just turn to GASB Statement number 70 on non-exchange financial guarantees. And it tells us that, yes, you'd continue to report the loan as a liability until you've been legally released from the debt. Big difference, legally released from the debt. So very, very simple and straightforward answer to that one for us. Now, for those of you in a water authority, a sewer authority, a technical college, or a community college, I know you all don't like this answer. I apologize for that, but please don't shoot the messenger on this one. Should CARES Act resources to a business type activity, that's the key there, you all report generally using a business type activity, or let's say you're a general purpose government, but you have some CARES Act dollars going into your water fund or your sewer fund, an enterprise fund. Should those be reported as non-operating revenues, or can we put those above the line and report them as operating revenues? Again, GASB looked at its existing guidance and said, you know, these are subsidies, and we always report subsidies as non-operating revenues, which is very unfortunate because your expenses are going to be reported above the line as operating expenses, but then the revenue to reimburse that is going to be shown as a non-operating revenue. So that's going to artificially increase your operating income or loss. I'm sorry, your artificially decrease or artificially increase your operating income or loss for that particular period. So Last question that GASB asked then was, should outflows of resources incurred in response to the coronavirus be reported as extraordinary items or special items? And GASB again said no, and looking at our criteria from GASB statement number 34, doesn't meet the definition of an extraordinary item and does not meet the definition of a special item either. So therefore, any outflows or expenses related to coronavirus should just be reported as operating expenses or expenses on your basic financial statements. That brings us to the conclusion of GASB Technical Bulletin 2020-1. At this point, we'll move on to GASB Statement number 83 on what we call asset retirement obligations. And I'll turn it over to Anthony at this point in time to address GASB Statement number 83.
Thank you, Fred. And now that we have all of the dates in terms of when these pronouncements are effective, we've kind of gone through those, and hopefully with the three different fiscal year ends that we put in there, we covered everybody there. But getting into the kind of meat and potatoes of the specific GASBs that are out there, starting with asset retirement obligations, or AROs as they are often referred to. You'll see this particular format on each of the pronouncements here. So what the standard is, why it was passed, why GASB undertook these specific projects, and then finally when these particular when these standards are effective. So GASB 83 was really intended to cover issues related to nuclear power plants that require significant decommissioning cost. And GASB told us that those costs should be estimated when the asset is placed into service. We're going to amortize that into the cost of using that asset over the life. So when it comes time to retire that asset, we fully expensed that particular cost. So we're going to look at a little bit more of the definitions here. But before we get into the specific definitions, before you think, oh, this is not going to affect us, there's no impact for us here, think about water wells as an example here. This is one that we regularly saw and came up that was effective as part of GASB Statement 83. So on the next slide here, we've got the definitions and scope for GASB 83. So an asset retirement obligation is defined as a legally enforceable liability associated with the retirement of a tangible capital asset. Key takeaways from that definition: that legally enforceable requirement that's usually going to come into place from either a state or a federal government level that requires you to dispose or retire that asset in a particular manner for that. So we went through this process for a lot of our Illinois municipalities, had a lot of conversations with public works directors, facilities managers, engineers for municipalities, and determined there wasn't a whole lot necessarily that fell under the 83 guidance because there wasn't legal obligations on those. One of the areas, as we noted, did include water wells. Water wells are required to be capped at the end of their useful life for that. So we did have to go through and work with the engineers and work with the public works departments to determine what those amounts were as part of that process there. Also within the scope of GASB 83, the retirement of that tangible capital asset, important to note that that's a permanent removal of that capital asset from service. Other utility operations that may come into effect here: water treatment plants, sewer treatment plants, electric generation, distribution. And again, there's a few things that this excludes specifically. Landfills are covered by GASB Statement 18. Pollution remediation obligations coming from related to any sort of abnormal operation are covered specifically in GASB Statement 49. And then any conditional obligations would not fall under the definition and scope of GASB Statement 83. So now that we've defined what an asset retirement obligation is, let's take a look at the recognition and measurement for how we're going to actually report these AROs. From an initial recognition standpoint, our ARO liability is going to be reported when incurred and reasonably estimable. The incurrence is manifested by both external and internal obligating events. So let's dive a little bit deeper into that definition for GASB 83 and kind of what some of those ARO amounts mean. So incurred means the asset we have has been placed into service. There's been a lot of initial misunderstanding in terms of the intent of the standard as to whether or not this should be when an asset is placed into service or when it's taken out of service, but it is when put into service. So it's a key component to this definition. For an external or internal obligating event, external obligating events include any laws, court judgments, or contracts that would legally bind the government Internal obligating events are going to be any actions that create an obligation for you. Those really can vary and will significantly vary depending on the type of asset and the type of related ARO. As part of that initial recognition, we're told to measure those based on the best estimate of the current value of the outlays expected to be incurred. That best estimate approach tells us, and simply put, incorporating all the evidence that we can at a reasonable cost into how we're reporting that ARO. The other side of that liability then is a deferred outflow of resources, reporting that at the same amount as the ARO liability. All right, so we've done our initial recognition of the ARO. In subsequent years, what do we have to do then? That liability, at least annually, we want to adjust that for any general inflation or deflation related to that ARO liability. And also on an annual basis, at least an annual basis, we want to evaluate any relevant factors related to the ARO. If there's been any sort of significant changes to the ARO, we do want to remeasure that liability when those amounts are significant. On the outflow of resources standpoint, very similar on the, to an expense, we want to amortize that in a systematic and rational manner over the estimated useful life of the capital asset, or over the asset, so the related ARO deferred outflow with that. If the asset that has the ARO affiliated with it is abandoned, you do need to immediately expense the remaining amount of that deferred outflow.
Anthony,
Right,
one thing.
Go ahead, Fred.
One thing that was very, very interesting that I found out not too long ago, a lot of governments don't have wells, and those that are along like Lake Michigan or a river where they might pull water out of, or Lake Superior, they're sitting back now and going, haha, we don't have any wells. We don't have to apply this portion of Statement 83. Believe it or not, if you have intake lines stretching out into Lake Michigan, intake lines stretching out into Lake Superior, intake lines stretching out into the Fox River, whatever it might be, you need to check with the EPA and make sure there's not a legal requirement that once you stop using that intake, that you can just leave that intake sitting there, or you have to do something with it, like either pull it out of the ground or fill it in with concrete and seal it up. So make sure you take a look at those intake lines for those of you that are bordering a large body of water and get your water from those sources. So.
Oh, it's a great point, Fred. And again, it's that legal obligation. So it could be a state obligation. So it could be a federal obligation as well as part of that. So it's a great point. Thank you.
I actually hooked an intake line while I was ice fishing this last weekend. So that's part of what triggered that. So
there you go. All right. So let's take a look at GASB 84 then on fiduciary activities. In GASB 84, the Y portion, I kind of, chuckle whenever I read this here, because GASB gave us the reporting requirements for fiduciary responsibilities, but never really gave us a definition as to what kind of fell under those categories there. So 84 aims to provide those definitions and provide the insight on how to report these fiduciary activities within our financial statements here. GASB 84 also has a implementation guide affiliated with it that was issued in June of 2019, and has the 50 plus questions in terms of specific circumstances that may be applicable under 84 there. There's a lot of useful information in the implementation guide, and the standard itself is effective at the same time as you do the implementation of Statement 84. So GASB 84 really gives us 4 paths to how we determine if something should be reported in a fiduciary fund. So you'll see here we have component units that are post-employment benefit arrangements. These are component units as defined by GASB 14, and then as modified, Statement 14 is modified, as well as post-employment, meaning any pension or OPEB, such as retiree health there. Our second path is component units that are not post-employment benefit arrangements. So perhaps if you're providing investment management for other governments, I would fall under kind of our second path there. Third, we have post-employment benefit arrangements that are not component units. So these are pension or OPEB that, while not meeting the definition of a component unit, do meet the definition of a fiduciary activity and would be required to be reported in a fiduciary fund. And then finally, our favorite catch-all here, all other activities. And this is really what we used to report as agency funds, but now report as custodial funds. And this is probably the path that's causing the most changes in practice. We'll talk a little bit more about that in a moment. So looking at this in a different manner on the next slide, this is really just more of a graphical representation of how we make this determination. So the first question asking whether or not our assets are held by a component unit, we'll answer that question, obviously yes or no answer there. And then asking the follow-up question, are the assets held for a pension or OPEB arrangement there? Based on the answer to that question, it's going to define for us which of the 4 paths that we take there. So really getting into detail there. For the next, go ahead, go to the next slide, and we are at our second keyword of the day. So far, we're going with our acronym theme here. So second keyword of the day is gap. Second keyword, gap. Got the extra A in there, so we're not talking about the retailer, not talking about company I worked for back in high school, but some generally accepted accounting principles. So gap is our second keyword here. All right, so diving a little bit deeper into fiduciary component unit here. Again, GASB Statement 14 provides the initial component unit guidance as amended by Statement 39, as amended by Statement 61, various implementation guides that change regularly. Just recommend when you're looking at the component unit definition, look at the codification for this to determine what is in effect. But ultimately, a component unit is a legally separate entity that the primary government is financially accountable for. We'll go into that a little bit more, but financially accountable, and in this case, we also have to either appoint the voting majority of the component unit board, we can impose our will on the component unit, or provide a financial benefit or burden. And the key, on the first 2 bullets there, there's an and, the key component to this. And then, or the final point there, the component unit is fiscally dependent on our primary government and provides a financial benefit or burden on the primary, or presents a financial benefit or burden on the primary government. GASB 84 does note that there is a financial burden in place if we as the employer are required to contribute to any sort of post-employment benefit arrangement there, and that's covered by paragraph 7 on Statement 84. So on our next slide then, looking at our all other activities. So we're gonna really, just based on time today, focus on path 4. Path 4 of what we're looking at here, all other activities, so our catch-all or default category here. For an activity to be classified as a fiduciary activity, we have to meet all of these criteria on this slide here. So we have to control the assets. Those assets are not derived, and again, keyword, they're not derived either from our own sole source revenues or from government mandated non-exchange transactions or voluntary non-exchange transactions. Now there is an exception here related to pass-through grants if we don't have any administrative or direct financial involvement. We also have to meet one of the criteria on the next slide. So assuming we've met those, look at the next set of criteria here. The assets have to be administered through a trust agreement or an equivalent arrangement in which we are ourselves not a beneficiary, dedicated to providing benefits to recipients in accordance with the benefit terms, and 3, legally protected from the creditors of the government. The next option, or the next bullet there, assets are for the benefit of individuals, and we do not have administrative involvement with the assets or direct financial involvement. And again, these cannot be derived from our own provision of goods or services to those individuals. And then finally, the last bullet, the assets are not, or are for the benefit of organizations or other governments that are not part of our financial reporting entity, and those assets are not derived from our provision of goods or services to those organizations or governments there. So if you meet the previous criteria there and anything on this slide, on the last slide here, then you have something that meets the definition of a fiduciary activity. So GASB, talks about when you have control. So when do we have control over an asset? If we hold the assets, or if we have the ability to direct the use, exchange, or employment of those assets in a manner that provides benefits to the specific or intended beneficiaries there. So again, we have to look at what that control is. Then we also have to look at the next piece of this on whether or not we have direct administrative involvement or direct financial involvement. And GASB really took a more of a closer look at these and provided some additional guidance on the implementation guide as it related to the administrative involvement or direct financial involvement. So some examples of administrative involvement: if you're monitoring compliance with the requirements of an activity that are established by the government or by a resource provider that does not receive the direct benefits of the activity, if you're determining eligible expenditures as part of this process, or if you have the ability to exercise any sort of discretion in how these assets are being allocated. Direct financial involvement: if you're providing resource matching for the activities there, that would be considered to be a direct financial involvement there. So how do we report these fiduciary funds? These are reported on the accrual basis of accounting using the economic resources measurement focus. Liabilities: we're going to recognize those when we have an obligating event or an incurred that compels us to disperse those fiduciary resources. Those events occur when we have a demand for resources that's been made and there's no further action, approval, or any other condition that's required to be taken by the beneficiary to get those assets released. So for example, here for any county governments, you'd recognize a liability when you collect taxes for other governments, even though you may not be required to distribute those taxes until a prescribed period or until a prescribed set of dates that you have for your distribution schedule as part of that. Any liabilities other than those to beneficiaries are going to be recognized in accordance with the existing standards using that economic resources measurement focus.
And Anthony, for those folks that are in Wisconsin, for the second to last bullet on that slide, you can go ahead and change county to city, because in Wisconsin, city governments collect those, the initial collection of the property taxes and distribute those to other taxing bodies. So,
absolutely, yep. And just looking at that and kind of going through that assessment process, you know, property taxes are one example of that. So if you have those dollars that are passing through that you're holding on behalf of another entity for that, go through the assessment, kind of follow the paths and kind of determine what that involvement, if there is the administrative involvement, if you have those, you know, if you have control over those assets, and go through those as part of your overall analysis process. It's a great point, Fred. So for GASB 84 financial reporting here, this is where you know, one of the bigger changes comes into play. So the statement of fiduciary net position, this is something that has previously existed. Statement of changes in fiduciary net position, you may have had this schedule as well in the past. But the biggest change relates to custodial funds. Custodial funds historically never had a measurement focus assigned to them. So if we had anything reported as in the funds formerly known as agency funds, we had corresponding assets, we had corresponding liabilities there, and there was no income statement presented. You may have had a supplemental schedule in the back of your report showing the changes in those assets and liabilities for the agency funds there, but you never had a basic financial statement related to custodial or to agency funds in the past. That changed with Statement 84 and gives us the custodial fund as a measurement focus affiliated with that. So,
and Anthony, that's interesting. That is one point that I think everybody really needs to pay attention to with implementing Statement 84 is a full income statement now and the full statement of change in fiduciary net position for custodial funds. Folks at Sikich review a lot of reports for GFOA certificate program. I know I serve as a special review committee member. I looked at a report recently that early implemented GASB 84 based on the revisions to Statement 95. And all they did was change the title from an agency fund to a custodial fund, but they still had assets equaling liabilities and no income statement for it. They're probably going to end up getting a qualified certificate, if not getting denied the certificate for that. So make sure you don't make that same mistake. Make sure that you're putting in a full income statement now and a full statement of financial position for those custodial funds. Great point, Anthony.
Nope, and that's, you know, in terms of, you know, these standards, Fred, it's key to have an understanding of the context of what the standard is doing and actually what the impact is going to be. So, you know, if you're uncertain as to what the impact is going to be for your organization or for your entity on that, you know, talk to your auditor on that, go through and make sure that you have the information you need to be able to implement and have that implemented in the correct manner for that. One thing I'll mention too, this is kind of unrelated, but Fred, you kind of triggered the thought for me there. If you're taking advantage of any of the GASB 95 deferrals of any of the implementation dates for the pronouncements, one of the things we would recommend in terms of including in your notes to the financial statements there is a note within your summary of significant accounting policies noting that you have deferred the implementation date for any particular pronouncements that you are doing that for. That's a great tool and kind of aligns with the GFOA certificate program there. That way a reviewer is not going to be looking for those pronouncements if you have deferred implementation on that. So.
And again, so you don't reinvent the wheel. If you're looking for some samples, Palatine, Illinois for their 123118 or 123119 CAFR is a good example. Hunt, Illinois for 123119 is another good example. Madison, Wisconsin for 123119 is a good example. And if you're an educational institution, Elgin Community College, Waubonsee Community College, I believe Oakton Community College, McHenry County College, and Rock Valley College all implemented GASB 84 for their student activity funds as of June 30th, 20, and went through some significant changes in how they account for their student activity funds. So some real good examples for you all to take a look at if you'd like to.
And encourage folks to look at the implementation guidance as well. There's some specific examples there. So if you're looking to determine, well, do we have direct financial or administrative control there? There is some great guidance and some great Q&As within the implementation guide on that as well. All right, 87, the one where we get the most relief under GASB 95 here. And thankfully so. GASB 87 is somewhat of a beast of a standard, and a lot of changes come into play with GASB 87 for that. But GASB looked at their lease conceptual framework and noted that it had been in place for decades really without being updated for that. Many of you may know that FASB and the International Accounting Standards Board went through a comprehensive lease project as well and updated their guidance as part of their lease accounting and financial reporting. And GASB also said they wanted to have a chance to increase comparability and usefulness of information and reducing complexity for preparers. The reducing complexity, maybe not in the year of implementation for that, but I think going forward and having more of that comparability across the board for that. So GASB, this is a long project that they undertook as part of this. And with GASB 87, even though we have an 18-month deferral on 87, would strongly encourage you to start looking at this standard now, gathering the information now, talking to your other departments, really getting a good handle in terms of what you have in place at your organization for leases on that, just because it's going to make your life that much easier when you actually do go through the implementation. So looking at go ahead.
Hey, Anthony, one thing we're not going to cover today, we're not going to cover any future guidance that's coming out in GASB's implementation guide for 2021. And I did read that recently because I needed something to do while I was ice fishing when we weren't catching anything. There's about 40 questions on implementing GASB 87 in this new implementation guide. It's still an exposure draft, so GASB will be voting on it in the near future, but some real shocking things in that implementation guide. So definitely take a look at that draft.
Absolutely. Yep. There's particularly if you're interested in a really, I would describe as a head scratcher of a question, check out question 4.11 on short-term leases, and don't shoot the messengers on that one. That's an interesting one in terms of GASB's interpretation of what meets a short-term lease. I'll leave it at that for today's purposes. But so GASB 87 is applied to any contract that meets the definition of a lease. The key lease definition here: a contract that conveys control of the right to use another entity's non-financial asset. So this is the underlying asset for a period of time in an exchange or exchange-like transaction. So it's key under the terms of a lease that the right to use asset is specified within the terms of that contract. And it also gives us definition and specifics in terms of what control looks like for that asset, either the right to obtain the present service capacity or the right to determine the nature and manner of use of the underlying asset. Simply put, leases are financings of the right to use an underlying asset. So GASB really wanted to give us a single approach to how to account for leases here, but with some exceptions, short-term leases being one of the key exceptions in how this is done. So under this unified reporting model for leases, what did GASB do? Well, no longer do we have the classification of leases into operating, capital, or any other categories for that. So if you're like Fred and I and have memorized, the capital lease criteria there, and you have nightmares thinking about bargain purchase options and everything else that we previously remembered for that, once you implement 87, you can purge that from memory. Those are no longer going to be part of the classification. There's no more operating or capital. You just have leases. Again, that underlying assumption that's out there that leases are financings Exceptions that would impact both the lessor and lessee would be short-term leases, as well as leases that transfer ownership and don't have any termination options. On the lessor standpoint, if you have leases of assets that are investments or certain regulated leases, for airport airline agreements are one that GASB specifically called out in 87 that would be accepted from the guidance under 87. That brings us to our third keyword for the day. Our third keyword for the day is lease. Third keyword for the day, lease. All right, let's look at the actual reporting then for a statement 87. We're going to look at this in a similar manner. This will be looking at this from a initial reporting and then a subsequent reporting, looking at this first on the initial reporting for the lessee standpoint. And this is really where we have some pretty unique differences on how we're going to report things. So lessee is going to report an intangible lease asset. So this is our right to use that underlying asset, again, specified in the contract. We're going to recognize that at the value of the lease liability, plus any prepayments and any initial direct costs that are ancillary to placing that asset in use. Our liability is going to be the present value of those future lease payments, including any fixed payments, variable payments, or any other payments based on an index or rate, as well as any reasonably certain residual guarantees that are part of that contract. No deferred inflows that are reported on the lessee standpoint. For the lessor, we're going to report our lease receivable. That really should be reported as the same amounts as what's in the lessee's liability. Here's a major difference between what GASB did in 87 versus what the FASB and International Standards Board did in their reporting on the lessor standpoint. FASB and the International Standards Board require derecognition of the leased asset. GASB said that's not really an accurate reflection of what happens in most of the leases that they reviewed as part of their diligence process on this. So you're going to continue to report that leased asset. No liability on the lessor standpoint, so you have a deferred inflow equal to the lease receivable, plus any cash received up front that relates to a future period. So that gives us our initial reporting for GASB 87. In subsequent periods, as the lessee, we're going to amortize that intangible lease asset. We're going to do that over the shorter of the useful life or the lease term. And our liability is going to be reduced by the lease payments less any amounts that are for interest expense. The lessor, because we are continuing to report that capital asset or that leased asset, we're going to continue depreciating that leased asset. Again, unless we have an indefinite life or we're required to have that asset returned in its original or enhanced condition based on the terms of the contract. We're going to reduce our lease receivable by any lease payments. Again, that'll be not including any amounts that will be needed to cover accrued interest. On a deferred inflow standpoint, as a lessor, we're going to recognize revenue related to that lease over the lease term, again, in a systematic and rational manner for that. So like any good pronouncement, additional disclosures required on the lessee standpoint. Going through just a general description here, I won't go through all of these in detail for the sake of time here. You're going to, key things, total amount of lease assets need to be reported by the major class of underlying assets, as well as any related accumulated amortization. The sub-bullet there, really a key point in terms of how these are required to be presented. You do need to report these separately from those tangible capital assets and the capital asset note disclosure there. Really a key part there. General description, what do we mean by a general description of the transaction? This is including the basis, terms, and conditions on which any variable payments might be based off of there, as well as the existence and terms and conditions of any residual value guarantees provided by the lessee that maybe weren't included in the measurement of the liability there. From the lessor standpoint, again, that general description, including the basis, terms, and conditions on that, total amount of any inflows of resources such as lease revenue or interest revenue, if those are not otherwise displayed. The amount of inflows of resources recognized for the period for variable payments and any other payments, if we have any residual value guarantees or penalties that were not previously included in the measurement of that lease receivable. And then finally, the existence, terms, and conditions of any options by the lessee to terminate the lease or abate payments if the lessor or government has issued debt for the principal and interest payments for that. So a lot of disclosures, a lot of information here. How do we actually implement Statement 87? We are going to apply this one retroactively. So restating, if practicable, the cumulative effect to the extent possible for that. I think the largest issue, and I kind of mentioned this earlier in terms of gathering the information for this, is going to be pulling all the information, getting a good handle on what you have out there for leases. For our large organizations that are on today, for our county governments that are on today that may have more of a decentralized nature for that, there may be leases out there that kind of fell into that previous operating category that payments were being made on there. You may be unaware that they were out there, but really are going to change in terms of how you have to gather that information and report that information and work through the journal entries to do that. Leases are going to recognize those and measure those using the facts and circumstances that exist at the beginning of the period of implementation there. So looking at hindsight in terms of how we're presenting those and how we're reporting those. Again, creating a standardized approach to do this is going to make your lives all that much easier when it comes to an implementation standpoint there. And the last piece here, if you're a lessor, you should not restate the assets underlying any existing sales type or direct financing leases as part of that process. GASB 87 as well has a significant implementation guide related to that. So encourage you to look through that and look through these and get a head start as early as you can when it comes to GASB 87. GASB 88 relates to certain disclosures related to debt, specifically looking at direct borrowings and direct placements. GASB really looked at the existing debt standards and felt that certain improvements could be made on the disclosure of debt. So looking at the definitions that GASB has here for us, liability arising from a contractual obligation to pay cash or other assets in lieu of cash, and one or more payments to settle an amount that is fixed at the date the contractual obligation is established. Really just a fixed debt, a fixed contractual debt, simply put, in terms of what GASB is looking at here under Statement 88. If we're looking at the determination here, looking at interest specifically, interest to be accrued and subsequently paid. If you have any variable rate interest with that or added to the principal amount of the obligation, if you have capital appreciation bonds, that would not preclude this amount being considered a fixed amount as part of that, so just take that into account. Leases, obviously covered by Statement 87, and accounts payable do not fall under the definition of what GASB 88 is covering. GASB 88 specifically looks at direct borrowings and direct placements of debt, and those should be distinguishable from other types of debt for disclosure. So if you have your long-term debt schedules, your debt service to maturity schedules there, you should be separately noting any direct placements or direct borrowings there. Simply put, you can do something as simple as putting an asterisk next to those amounts and disclosing which portions are direct placement versus which portions maybe were based on debt that was obtained on the open market there. From new disclosures, this is required for all types of debt. Here's one that many of you may have a line of credit, and you may have access to that line of credit for any short-term cash or short-term financing needs, but perhaps you don't use that very often, or you might not have a balance at year-end for that. If you didn't have a balance at year-end pre-GASB 88, you wouldn't have had to report anything related to that. GASB 88 says, well, no, if you have an unused line of credit, you're going to report that amount that you have available to the organization for that. If you have any assets that are pledged as collateral for debt, that's required to be disclosed under Statement 88. And then specific terms as part of the debt disclosure as well here. You can see those subjective acceleration clauses, things of that nature that would be required to be presented there. A lot going on the GASB standpoint, 83 through 88 there. But with that, I'm going to turn it over to Fred and go through probably one of our favorite pronouncements, one of the easier implementations that GASB's ever given us. So with that, Fred, back to you.
Thank you, Anthony. Yes, GASB statement number 89. If there was ever a pronouncement to early implement, it's statement 89. A lot of our clients at Sikich have early implemented this because all it requires to early implement is to change one note or one sentence in your summary significant accounting policies and just take out that sentence that says you capitalize interest on any self-constructed assets. Instead, you just expense these in the period now and treat it as a period cost. So One thing that remember, again, this applies to all accrual-based financial statements, but as we note in the fourth bullet, GASB 89 is only applied prospectively, not retroactively. Big change from other GASB pronouncements. So you would not restate opening net position or any prior periods to remove previously capitalized interest. You're just going to apply this on a prospective basis, and as of the effective date or the implementation date, stop capitalizing interest at the beginning of the year and just expense the interest on the income statement. So very easy pronouncement to early implement. Moving from there to GASB statement number 90. Statement number 90 on majority equity interest, real interesting pronouncement. I was struggling to see how this applied in the state and local government industry, and then found two of our clients that it did actually apply to, and we did implement that back with its original effective date. So now it's effective with GASB 95 for fiscal years ending December 31st, 2020 and thereafter. So, and this really came about because of a conflict with GASB statement number 72 on how to account for an equity interest in a particular entity. That's what statement number 90 does, is it modifies the definition or modifies our guidance for how we report a majority equity interest in a legally separate entity. What really is that? Well, think about a joint venture that you participate in. And if your participation in that joint venture results in you owning either 50% of the stock of that joint venture, or you have a right to greater than 50% of the net resources, net position, net assets of that particular separate entity, that joint venture, guess what? It's not a joint venture anymore to you then. It might be something else. So that's the key. Do you have a greater than 50% ownership in the equity of it in stock, or in the net realizable value of it, should it cease to operate and then be distributed? So if you meet that greater than 50% rule, first question GASB asks is, why do you have that equity interest? Is that there for profit or to generate income? If that's the case, then that meets the definition of an investment that we have from GASB statement number 72, and you would account for that under the equity interest method, and you would not report that separate entity as a component unit. And that brings us to our fourth keyword of the day now. Our fourth keyword is equity. So yes, we move from the acronyms and move to actual words now. So keyword number 4 is equity. So again, make sure you jot that down and put that into the box on the survey at the end if you're looking for continuing professional education credits. So.
But we've got a couple questions that came in real quick. I think we can address pretty easily here.
Sure.
So one of them was related to GASB 88, and the question was, we have to have a line of credit to process ACH vendor payments. Do we need to disclose this? And the answer in that case would most likely be yes. Any line of credit that's been extended to the organization would fall under the purview of GASB 88, and you would disclose that regardless of the purpose for this. So you would disclose that. You can disclose that with details in the notes in terms of the fact of what it's used for, but that would be something that you need to disclose there. The other question we had, Fred, relates to 89, and the question was, would interest on bonds issued for the purpose of construction be capitalized under 89?
Oh, great question. And the answer is no. That's exactly what 89 is referring to, is we would no longer capitalize that interest on any type of that transaction where we're constructing an asset. So, yep, great question.
All right, back to you.
Or did you want to answer another question or two? I see another question or two in there too. So someone had a question on wells and materiality. Make sure that if your engineer is telling you it's less than $10,000 per well to cap it and close it and take it out of service, make sure you have that well documented, because I would agree that could be a material. That's a lot lower than what we're getting from our engineers that we've been working with, though. Most of ours, it's somewhere, and again, that could be a very shallow well. A lot of the wells that we find here in the Midwest are more the deep wells, and it's anywhere from 100,000 to 200,000 per well to cap those and properly take them out of service in accordance with the legal requirements. So yes, we always apply materiality to that. Make sure you've got a good engineer coming up with some estimates for you. The estimates we have were actually based on 2 wells that were taken out of service and had to be capped within the last 3 to 4 year period. So, and then there was another question on GASB 87 with a rental agreement on a copier, and there's no $1 to buy at the end. Would this not fall under GASB 87? If you can buy something at the end of the lease agreement for $1, that's a bargain purchase option. GASB said we would not apply GASB 87 to anything that transfers ownership at the end. We're just going to treat that as an installment purchase contract as opposed to a lease. So great questions. Okay, back to GASB 90 then. If the intent of holding this is not for profit, but instead to provide services to your constituency, then you don't meet the definition of an investment, but you do meet the definition now of a component unit because you're financially accountable for that through your majority equity interest. So therefore, you'd have to report this joint venture now as a discretely presented component unit in your financial statements. And in addition, as we note on the next bullet, still report your investment under the equity method in either your government activities or your business type activities, wherever the investment in that joint venture came from. So big change with statement 90 from that standpoint. So the next pronouncement is GASB statement number 91, if I can get my screen to move. There we go, on conduit debt obligations. Doesn't impact a whole lot of us on the call today unless you're a municipality, because most governments cannot issue industrial development bonds or industrial revenue bonds. Counties usually can't do that. Special districts can't do it. It's really just cities and municipalities and state governments that have the conduit debt issues. So generally what we found was GASB interpretation 2 was being applied inconsistently in practice, especially by some large governments and some state governments. And then we also had a little bit of conflict with GASB statement number 70 on non-exchange financial guarantees. So GASB reviewed the entire interpretation 2 and statement 70 and said, you know what, we probably should come out with some additional guidance on this. So that's what statement 91 does. And that's again effective for fiscal years ending December 31st, 2022 and thereafter if you follow GASB statement number 95. Very simply, a conduit debt obligation is a debt instrument that's issued in your government's name. So that's the key. It's a bond or a note in your government's name, but it's for the benefit of the third party that's outside of your government, and the third party is primarily liable for the repayment of that debt instrument, what we call a third party obligor, and that agreement has all the following characteristics. There's 3 parties involved: the issuer, you whose name is on the debt, the third party obligor who receives the proceeds, and then a debt holder or debt trustee, oftentimes a bank. The issuer and the third party obligor are not within the same reporting entity. They have to be legally separate entities. The debt obligation is not a parity bond of the issuer, meaning it's not a parity bond with other revenue bonds that you might have outstanding, nor is it cross-collateralized with other debt of the issuer. The key here is this bullet: the third party obligor or its agent, not the issuer, ultimately receives the proceeds, and the third party obligor, not the issuer, is primarily obligated for the payment of all amounts associated with that debt obligation. What GASB 91 does is, just like interpretation 2, require no disclosure that you have these types of bonds outstanding, a description of your limited commitment under these bonds, which is basically to maintain the tax-exempt status of them, because that's why the entities are coming to you for an IDRB or an IRB. They want that tax-exempt interest rate, which lowers their cost of borrowings then. In addition, we might have to have a description of any additional commitments that we might make, and then to the extent none of these are recorded as liabilities because they're not, disclose the aggregate amount of principal outstanding at the end of the fiscal year for all your IDRBs or IRBs. Easy pronouncement. GASB statement number 92, the next pronouncement on omnibus. And again, GASB doesn't issue interpretations anymore, so now they come out with an omnibus pronouncement. I have a couple of items in statement number 92 for note. Specifically, the application of statement 84. Remember, Anthony told us that in GASB 84, paragraph 7, it defined a financial burden as an employer having to make a contribution to a employee benefit plan. They changed that now with statement 92 and said, no, that's only for contributions to defined benefit pension and OPEB plans, not defined contribution plans. So they did make a significant change there to that guidance that Anthony gave us earlier. So make sure you're aware of that particular change for that. So GASB statement number 93, those of you that don't have derivatives, go ahead and grab some sushi for a minute because this doesn't apply to you though. I think we have 3 entities on the webinar today that this may apply to. So if you have a derivative instrument, such as an interest rate swap or a debt swap or something like that, and that derivative instrument is based on an interbank offering rate, what we call an IBOR, or the most common one is the London Interbank Offering Rate, or LIBOR. Understand LIBOR is going away at the end of 12/31/2021. So if you have a hedging transaction based on LIBOR, what happens to that transaction after 12/31/2021 when LIBOR goes away. That's what Statement 93 was issued for. And basically, GASB gave us a solution. They said, you know what? Generally, if you change something in your hedging transaction, you have to recognize that hedge and have a new hedging transaction created. GASB said, but in this instance, because LIBOR is going away, we don't want you to undo all of your hedge accounting that you've had in existence for that transaction. So continue to apply that accounting as long as it's an effective hedging derivative instrument. And you're going to swap out the IBOR with the new rate that meets all the criteria that we have on the slide. So you're going to replace it with a reference rate, and then you're going to adjust that new rate by a coefficient or constant to basically get it to equate to the old rate. And you might have to make an upfront payment limited to what is necessary to essentially equate to that rate. So again, if the original hedging derivative instrument is ended and replace it with a new hedging derivative instrument and the same date, you do not have to undo that. You're just taking out this rate. So, and then the critical terms between the previous hedging transaction and the new hedging transaction pretty much need to be the same. And those are the critical terms that we have on the next slide in terms of the frequency of which that index rate might reset, the date on which it resets. And again, those don't have to be identical to the original agreement, but does have to contain these critical terms as part of the overall hedging transaction agreement. So, Statement number 94 was issued to cover public-private partnerships and availability payment arrangements. Now, a lot of us probably said, isn't this already covered under GASB Statement 60 on service concession arrangements, or maybe now under GASB Statement 87 on leases? And the answer is, generally, we thought it would be covered under a lot of these, but GASB has found that there's a lot of transactions out there, especially outsourcing the operations of a golf course, a swimming pool, or some other revenue-generating facility that's not covered by GASB Statement number 60. So we didn't have much guidance on that. This is effective for fiscal years beginning after June 15, 2022, or in our terminology, fiscal years ending June 30th, 2023, and thereafter. Now, with a public-private partnership, meaning it's between a government and a private entity, or it can be a public-public partnership, as we call it the P3s. So there are arrangements in which you, the government, the transfer, contracts with an operator, and that operator can be another government or a non-government. I know here in Illinois, we work with a couple of clients that one entity owns a golf course, but they outsource the operations of the golf course to another government. It's exactly what they're talking about here in this particular pronouncement. So great example there. And you provide public services by conveying the control or the right to operate that non-financial asset, that capital asset, such as infrastructure or another capital asset, like a swimming pool or a golf course, for a period of time. And the key here, it's an exchange for an exchange-like transaction. Now, contrast that with just an availability payment arrangement. With an availability payment arrangement, it's very similar to a 3P, except with that, you're contracting with another entity to operate or maintain the government's non-financial asset. And instead of being a long-term, you're just getting a payment on an annual basis. So, primary difference between a P3 and an APA. So, with a P3, if it meets the definition of a lease in Statement 87, but not this definition of a service concession arrangement, we report that under Statement 87, unless the underlying triple P asset or P3 asset are not existing assets of the transferor, or there's required improvements to be made to that. And we have to really apply an APA to that. So, because then an APA is related to the overall design, finance, or construction of an infrastructure or other financial asset. And we report that basically as a financed purchase of the asset, very similar to what we just talked about with that last question, an installment purchase contract. So, an APA that is related to operations would just be accounted for, as I noted, as a flow of resources, revenue to the recipient government, expense to the paying government in the period in which the payments relate to. So, from a transfer reporting standpoint, for all P3s, they're going to now recognize a receivable for installment payments to be received, if any, over the life of that agreement, and then offset that by a deferred inflow of resources for any receivable that's being recognized, including any payments that were received from the operator before the start of that P3 term. If there's a new asset that was created, then we have the additional guidance that you see in the second box there on the slides. From an operator standpoint, the operator then would recognize a liability for any installment payments, and I apologize, that should be to be paid, not to be received, so I have an error on that slide there. And then also, you'd recognize an intangible right to use that asset. So you have an asset to offset that liability with. So, but that's if there's an existing asset. If it's not an existing asset, then again, we have to apply the different criteria that you see that last box on the slide. So, and that brings us to our third keyword, I'm sorry, our fifth keyword now, and our final keyword for the day, which is report. So again, if you're looking for that continuing professional education credit, please make sure you drop down and add that fifth keyword to that survey. So, okay, I know we're right about out of time, so I have two pronouncements to cover still. Statement 96, I'm just going to tell you, because I'll do a detailed presentation on this maybe in another quarter. Statement 96 on subscription-based information technology arrangements, or what they call SPIDAs. I call it a SIMDA, GASB calls it a SPIDA, whatever. This is effective for fiscal years ending June 30th, 2023, and thereafter. It was not impacted by the implementation of GASB 95, so the implementation date did not change. Basically, what a SIMDA is, it's a subscription-based technology arrangement, which is basically a contract that gives you the right to use another party's software, either with a tangible asset or by itself, but it's up in the cloud. So you're not owning the software, you don't have a license agreement for the software. It's just a long-term arrangement to use someone's software in the cloud. Because of that, we're going to treat it very similar to a lease, report an intangible asset, and also report a long-term liability related to that. And again, we'll come back with a detailed presentation on this one for you. So the last pronouncement that I wanted to cover before we leave for the day is GASB statement number 97 on certain component unit recognition. So, because we did mention that this changed now from what GASB had originally in statement 84. And this is one example where when you all say something to GASB and emphasize to GASB that something's wrong, they do listen to you and they come out with revised guidance to address that issue. So we were telling a lot of you 2 years ago that you might have to report your 457 deferred compensation plans under GASB 84. And just like us, you all went ballistic. And you started calling GASEC members, GASB staff, and said, you all have to be kidding us. You told us to take the 457 plans out back in 2000. Now you want them back in? Are you guys goofy up there? And they looked at it and said, you know what? Yeah, we might have some technical issues with statement 84. So they revised it now with statement 87. What statement 87 tells us that is, remember that component unit criteria Anthony went through? They said if your 457 plan or your other employee benefit plan does not have a governing board, your governing board then is basically serving as the ex officio governing board for that. They said this applies to all except for defined contribution plans and defined contribution OPEB plans or other employee benefit plans. So they carved out that exemption for us. And then they said the legal obligation to contribute is considered to be a financial burden, applies only again to defined benefit plans. So that took us out of the GASB 84 reporting entity criteria there. Said no, these are not going to be component units if we meet this new definition now. However, if we have employer contributions that are required to go into a 457 plan, and I know there's a lot of special authorities out there in that instead of participating in a statewide plan like the Missouri Loggers Plan or the Illinois Municipal Retirement Fund here in Illinois or the Wisconsin Retirement System in Wisconsin, instead they have a 457 plan because they don't qualify to participate in that statewide pension plan. So they have a 457 plan that operates just like a pension plan where they're required to make an employer contribution to that. GASB said in that instance, we would treat that 457 plan as a pension plan and apply defined contribution pension plan disclosures to it. So you'd report and disclose in those financial statements the same criteria or the same, disclosures that are required for a defined contribution pension plan, because that's really what that becomes. So on behalf of Sikich, Anthony, I would like to thank you all for sticking with us for the last hour and 15 or hour and 20 minutes. Any questions that you have, please continue to submit those through the chat box, and we will do our best to respond to those. We're out of time now to respond to them, but we will follow up with an email to you. If you'd like to reach out to us directly, you see both of our phone numbers on there, as well as both of our email addresses. Please feel free to reach out at any point in time with any questions that you have in regards to these pronouncements or to any of the topics that we covered in today's webinar. Again, on behalf of Sikich LP, we thank you for attending, and we hope to see you at a future webinar or participate in a future webinar and see you at a future conference. You all have a wonderful day.